All right, in this lesson, I'm going to discuss the audit committee and the importance of the audit committee to our auditors and to an organization and company. Now, when we talk about audit committees, specifically, we're talking about public companies. We're not necessarily talking about private, although private can work this way. It's just there's a little bit more leniency with all of this when we talk about private companies. So a private company also may not have an audit committee because the board of directors may be put together of all the owners, and so there may not be independent things, independent people on the board of directors. So again, this has to do with public companies. Private companies get a little bit of leeway in all of this. So audit committee, what is an audit committee? Well, first of all, let's start with the board of directors. So we have the board of directors here, and if you've never been on a board of directors or don't know how board of directors are put together, basically the board of directors are usually investors that have some type of expertise that is important for the organization or the entity or the business, and getting their insight on how to move the business forward is important, so they become part of this board of directors. The board of directors is responsible for the strategic plan of the organization. And so when we say what's the business going to be in 2, 5, 10 years, it's up to the board of directors to kind of focus management in what they're supposed to do. Now, it's management to implement all of those strategic plan, but it's really up to the board to kind of figure that out for management, okay? And so we have the board of directors, and it's made up of members. Members are independent or not independent. So you could have a board of directors, or you could have members of the board of directors that are not independent. What do we mean? Maybe they are the president and CEO. So maybe we say the president and CEO is the president and CEO and a member of the board. We might say some of management is on the board. We may even say an employee is on the board. So people are on the board that work for the company or in the organization that they're on the board for. Then we have independent board members. These are members that are not part of the organization. They don't necessarily work for the organization. They receive maybe a stipend from the organization to be on the board, but that's only for their interaction on the board, not necessarily they work for the company. So maybe that's a CEO of another company that provides great insight, and they want them on the board because having that person on the board gives good direction for what the company wants to be in 5, 10 years. And so they ask this person to be on the board. That is now an independent board member, okay? And usually it's an investor, okay? So that it's not just a random CEO. The CEO is probably an investor, so they're bringing in that independent board member, okay? Well, the board is the board, and underneath the board are a whole bunch of subcommittees. So typically what happens is you might have each board member sit on a subcommittee, or a couple of board members, or a board member sits on a couple of subcommittees. These subcommittees are more focused in what they're doing for the board. Now, typically a subcommittee has nobody on it except for board members. So it's not like employees and board members coming together and creating a subcommittee. A subcommittee is a committee of the board of directors, and they're tasked with certain things that they need to do. So for instance, I might have a board of directors and a legal subcommittee, people that deal with the strategic plan of the legal stuff. Then you may have the board of directors, you may have a subcommittee of audit committee. Okay, their job is to audit the organization that they are sitting on the board for. Then we may have a compensation subcommittee. That subcommittee looks at the compensation of maybe the highest paid employees in the organization and make sure that they're appropriately paid for their services rendered. Or maybe their job is just to look at compensation for the CEO and president, and then offer suggestions to the board on whether or not to accept a raise or decrease or whatever it might be. And then maybe a subcommittee that works on the technology strategic plan for the organization. So these are subcommittees. Sometimes we call them working committees, because those are committees that actually work on things and then present them to the board, the full board, and the full board makes decisions on that as a whole. And so one of the subcommittees is that audit committee, and that audit committee's job is to hire the auditors, fire the auditors, pay the auditors, not out of their pocket, but make sure that they're paid. Their job is the auditors, okay? Now, from there, we also have internal audit. We've talked about internal audit is basically hired by the company management to perform internal audit. Now, we like internal audit to be separate from management, which means they have a direct line to the audit committee. So if the VP of internal audit finds a problem, that VP of internal audit can go directly to the audit committee, bypassing all of management. And the reason for that is management's creating fraud. They need to be able to tell someone, and that someone that's independent is audit committee. The audit committee then can act on its own behalf to try to figure out what fraud issues are happening. So again, we don't want this to go to the president, because if the president is committing the fraud, the president can then start to hide things or bury it so that nobody knows about it. And we don't want that to happen, so we take it to the audit committee, who's independent, and these are independent board members, and then they will act on behalf of the organization to fix that problem, get rid of the president, hire forensic accountants to go in and find out what was stolen. That's what could happen. Okay. Then we have management hired by the board of directors and then employees. Okay. Now, for public companies, the audit committee hires, reviews, and fires the auditor. The audit committee sets the terms of the engagement with the auditors directly. So their responsibility is the auditors. The auditors are not hired by management. They are paid by management. Management has to pay them through the regular operations of the organization. But internal audit in itself, the auditors report directly to the audit committee, and the audit committee reports directly to the auditors. The auditors don't need to report to management. Now, they're going to work with management because they need to work with management in order to get the audit done, but they don't need to report to management. They report to the audit committee. All right, so Section 301 of the Sarbanes-Oxley, SOX is an abbreviation for Sarbanes-Oxley. So Section 301 of Sarbanes-Oxley gives a little bit of color to the audit committee and what public companies need to do with their audit committee. So the audit committee must be members of the board. So these people must be members of the board. They must be independent from the company. They cannot be an insider management. So these are some of your independent board members. So we talked about some board members can be internal, not independent, and some that are independent. We're not saying all independent board members are part of this audit committee. We're just saying there's a select couple of them, or 5 of them, that are part of the audit committee, and all 5 of them are independent in nature from the organization. Okay? They're responsible for the auditors. They must pre-approve all audit and not audit services. They handle complaints of accounting or the auditing, so they're the complaints people, and be able to independently engage in legal counsel should they need to. And that's, again, because if something happens here fraudulent here, internal audit or the auditors, external auditors, will go to the audit committee. They need to be able to have the resources to engage in legal counsel so that they can get to the bottom of it. Because if all they can do is tell management, hey, we think there's fraud going on, what is management going to do? Well, if it's them, they're going to say, okay, well, we'll handle it. Well, we don't want that in an organization, so we give the resources to the audit committee to do it themselves, which is to involve legal counsel, which also might be internally firing the president, taking it to the board, and then finally firing the president, or AKA asking for a resignation. Okay? So that's what is required by SOX of all audit committees of public companies. So if you're doing an audit of a public company, they must adhere to these rules when it comes to their audit committee. So this lesson is all about giving you an idea and understanding of an audit committee for a public company. Hey, thanks for watching my video. If you like what you saw, make sure you press the thumbs up button that's right below here. If you have any questions, make sure that you leave a comment or that question in the comment box below. And if you haven't subscribed yet, make sure you press the subscribe button. It's just below me. Hey, if you want more videos like this, make sure you go to www.patrickleemsa.com to see more videos like this, or if you just want to learn more about accounting. Thanks for watching. We'll see you in the next video.